Hi, everyone. It's great to be here. My name is Liz Wilke. If you do not already know me, I am, in fact, Gusto's principal economist. I lead the economics and data research team here at Gusto. I'm also a Leo. My favorite color is red, and my favorite ice cream flavor is Neapolitan. Because in here, I'm like 80 years old. And before I was an economist, I had a short-lived but very promising acting career. I had a role in this film. It's the 2007 film Grindhouse, where Rose McGowan plays a go-go dancer with a machine gun peg leg who escapes a zombie apocalypse in a small Texas town. If you are from Texas, you're probably like, that's plausible, right? Who did I play? You're wondering. Anybody? Yeah. For those of you who did think, is she the girl on the back of the motorcycle? Thank you. But no, that is me. I am zombie extra far left. Despite the auspicious start to my career, I am glad that it did not work out, because now I can be here with you all today, sharing my real passion, the economy. Many of you were at Next last year, where we launched The Economy Explained. For those of you that were not, I'm happy to share that The Economy Explained is Gusto's quarterly economic advisory service for partners, because the economy is like the weather, and you need to know the forecast in order to prepare. So each quarter, we release a video, a blog, and a one-pager talking about big trends in the economy and what they mean for small business, and what those trends mean in terms of how you should prepare and what it means for you and your businesses and your clients' businesses, because they are asking you, what do I do? That can help you be more successful and add value to them, and it is only for you all that we do 32 metro areas and 17 industries that you can find in Gusto Pro. Those are only for you to add value to your partners. So, jumping off with headlines this quarter, what you need to know is that we are no longer in a short-term talent shortage. We are in a forever talent shortage. So all of your short-term talent strategies are now your long-term talent strategies. We'll talk a little bit about what that means. It also means that financing is getting more expensive. We'll talk about how to advise your clients to delay investments, find savings, think about cash flow. And then we will add slowing consumer spending, which is finally starting to slow. American consumers have been incredibly robust. They have been spending like it does not matter. We're finally starting to see that stabilize a little bit, so that'll mean things for your clients' revenue. All right, what that means to focus on. It means investing in retention through better benefits, career development, and of course compensation, but I'm actually gonna argue that it's not as much compensation as you think it is, that there are actually real gains to be had in benefits and career development. I am also going to talk about expanding the workforce that you and your clients draw from. I know lots of you have already thought about expanding your workforce, and I would love to hear more about your own experiences. But 4 to 5 million businesses have been formed every single year over the last 3 years, and that means there's lots of freelancers and people who are working for themselves out there that your businesses probably haven't tapped into yet. It means helping clients think through systematically through their likely cash flow situation, not over the next month, not over the next 2 months, over the next 6 months, 4 months, 8 months, right? And find places where they're gonna be a little soft and help them think strategically, how am I gonna handle that slow September that I think is coming? Where am I gonna find cash savings in order to be able to pay those bills without accessing credit markets? And we're gonna meet consumers where they are through mid-level pricing, discounts. Advise your clients, don't let businesses sell just what they're selling. Let them sell the incomparable experience of getting a good deal. That is gonna help consumers a lot. So retirements, entrepreneurship, and changing industry needs are creating talent demand that far exceeds talent supply in almost every industry. And that is going to be true for the long haul, right? People aren't getting any younger, despite all the money we are throwing at that problem. They are going to continue to retire, and workers are changing what they fundamentally value in their work lives. There is good news in the short term. Over the last year, new hire pay went up 10%, and it has now come down 7%. Thanks to Gusto's new hire pay data, we can actually see that stabilization. So you were churning, trying to get people in and pay them whatever it took to get them in the door. Those days seem like they're over for now. There's not so many people, but you're also not paying them a king's ransom just to show up on Monday morning. And workers are also feeling less confident, which we see in the quits rate, right? Which is the likelihood that a worker quits their job voluntarily. They're feeling less confident. So they're not saying, you can take this job and you can do you know what with it. They're now thinking, maybe I'll just hang out here a little bit longer, see what my options are, maybe figure it out. Yet, there are still 1.7 new jobs for every unemployed person in this country. It went down to 1.4 earlier. It's now back up to 1.7. It's not quite 2.0, but it's going to be way over 1 for a long time, especially in industries like healthcare, accounting, and service industries. Do you know that they are proposing to lower the age that you can serve alcohol to 14 in Michigan because there are not enough people above the age of 16, which is the current age that you can sell alcohol in Michigan, to work these restaurant establishments as a sign of the talent shortage that these industries are facing. I don't want to single Michigan out here. Like 12 other states are doing it. Michigan just was in the headlines recently for it. So the pressure is on to get your long-term retention strategies. This is not a problem that is going away. It is not a problem that we just need to sort through. Putting good retention strategies and practices in place is going to be key, because if you lose a worker, there's not another worker coming in to take their place. Getting businesses to focus on benefits and career development to keep them in the long term and to keep them productive is really going to be key, because the costs of turnover are going to be elevated. And also focus on fractional, global, and freelance employment. Look up, help your clients think about where talent can come from, if not in their own backyard. A lot of you already have experience with international employment. I would encourage you to help your clients think about that too. Gusto is one of many companies that are launching solutions for customers looking to expand this access to talent. As I said about benefits, I really want to focus on 401k for you all. Actually, on our platform, only about 25% of businesses offer a 401k. We calculated how much it reduces the risk of attrition over 12 months, and what the turnover cost would be associated with that. And the ROI on offering 401k for a small business is over 100%. It's one of the best investments a small business can make in their talent strategy, because it's inexpensive and it has this huge return, especially relative to healthcare, right? So this is really somewhere where you can help your small business clients stand out and get employees that are stickier, right, than they otherwise would be. And then, of course, on the international talent side, remote or hybrid businesses that are currently working like a standard 9 to 5, 10% of them are already having international employees, and that number is just likely to grow in the future. Okay, financing. There are 2 contributors to tightening financing conditions in the market. Remember that? How many of you are like, oh, all right, that happened. It feels like forever ago. What is time? Anyway, banks are a bit scarred, and they are a bit scared. So the SVB crisis taught them that banks can face risks that they haven't even thought about, and they are moving to tighten up their balance sheets. It also means they only want to provide credit under very good conditions to them, to very highly qualified lenders, and that is affecting your client's ability to access financial markets for loans and other products. And that guy. They all look the same to me too. That's Jerome Powell. He's the current chair of the Federal Reserve, and he is personally dedicated to bringing inflation down to 2% by raising interest rates to their current 22-year high. And that is why last quarter, 47% of banks tightened loan standards. 38% of them reduced the amount of credit that was available to small businesses, and 58% of them increased the costs of credit more than they reduced them. These are big jumps up in just a couple of quarters, and they are definitely affecting small businesses' ability to access credit in the financial market. So focusing on looking ahead the next few months with your clients and identifying what their cash flow issues are likely to be. Many businesses are seasonal. Many businesses have contracts that are either going to extend or run out. Help them think strategically so that they don't end a month with a cash deficit that they did not expect, and they don't have any money to pay the bills that they need to pay, because otherwise they're going to put it on a credit card that's more expensive. They're going to go try get a loan that they can't get. And that's going to put them in financial distress, and you all have the power to help them sit down, take a beat, and think forward. Also, help them focus on earnings and cost savings. Maybe there are retained earnings, automated or expedited invoicing, and tax credits. We'll talk a little bit about R&D tax credits later, but small businesses do not use the tax credits they are entitled to by the laws of this country. The R&D tax credit on our own platform, the average small business that gets a tax credit is eligible for $17,500 in tax credits against their payroll liability. The average business, because they're not evenly distributed, is 2.5 times that. So your small business clients could be sitting a lot of money that could really be helping them manage their cash flow. Consumers. That's us, y'all. We're all consumers. They have been defying expectations for well over a year. They've got this big buildup of savings. They have this very good labor market, and they are having a good time. Everybody was spending it like they could not get rid of it fast enough, y'all. And we did. We spent so much money last year. They defied everybody's expectations. Economists are like, people are rational. They'll realize that this can't last forever. But no, we were wrong. We were totally wrong about that. And we did. And we spent a lot of it. And now, right, we don't feel quite that good. We're a little more like this. We are vibing a little bit more conservative. The thing is, folks generally feel good about their specific situation. They're like, my job is good, I feel good about my prospects, but we've been talking about this recession for so long, and maybe it's getting a little loose now, and maybe, I don't know, maybe my neighbors don't feel so good, and I don't know how I should feel, so maybe I'm just gonna hunker down a little bit and think about how much money I'm putting on that credit card this month. So they're not totally pulling back, but they're stabilizing a bit. And we're seeing their financial situation, I'm going to say, drift sideways, right? So consumer loan deficiencies, that's how many people are late or delinquent on their credit cards. I know some of you are in this number. They have risen about 50% since last month, and the consumer spending has been flat for the first time in a really long time. It means there's a real stabilization and that households are feeling some of that financial distress. Before you quickly repeat this 46% number on your WhatsApp group, it's like a really small number on a really small number. It's actually just bringing us back up to pre-pandemic levels. So as healthy as you thought households were in 2019, that's where we're back to. But what does this mean for your clients, right? In terms of advisory, it really means consumers aren't here to rain money on all of us anymore. They're happy to spend, though. They just want to make sure that they're getting a good value out of it, right? So luxury items, for those of you who have clients that really specialize in luxury experience and goods, you might encourage them to pull back a little bit and focus more on mid-level. But we are not bargain basement shopping either. So mid-level pricing, discounts, the good feels that come with a sale, those are things that your clients can lean into in order to keep demand up as we move into the holidays especially. All right, 3 things to take away from this conversation. 1, keep your people. They are not out there. There's not going to be a big wave of them coming back into the labor market. Pretty much everybody who can be in the labor market now is in the labor market. And all the people who got these big 401k stock bumps during the pandemic, they all retired and they're not coming back because they like the golf so much. But really, focus on long-term strategies to retain people. That's in benefits, it's in career development, and it's about thinking about alternate, fractional, freelance, and global employment. Get your clients' cash flow in shape. This is going to be a major contributor to how much capital they have to access and how much stress they're going to feel paying it back. And for your clients' customers, again, help them focus on that mid-level and really add value to the pricing and services that they have. And where they can get into long-term contracts and commitments, help them to do that, right? Because it's going to ease their cash flow. You can also find the one-pager and the blog that we have associated with it. You can find the industry and Metro one-pagers in Gusto Pro. and for all of the other great gustonomics research and data that my team produces, including that bit on 401k. And if you are a podcast person, I'm happy to announce we have you covered. We have a new podcast that just launched last week, and trust me, you have never had so much fun thinking about commercial real estate loans. That's it for me, y'all. Thank you so much.